So when I first started my journey to create a second source of passive income, or to create my multiple streams of passive income, the second source was that I wanted to get into the stock market, and I wanted to really understand how to create passive income in the stock market. One of the most powerful ways that I learned to do that was through dividend investing. I went a little gung-ho, probably YOLO'd a little more than I should have. So I'm going through the next several videos. I'm going to be going through all of my portfolio and going in and really doing a deep dive into each of the positions that I've taken and try to figure out if I should keep the position or if I should sell or if I should buy into a new position or new holding. So I hope that you'll join me on this journey as I share with you in this video an evaluation I'm going to do for 9 of my current positions in the communication sector, and I'm going to share with you which ones I'm going to get rid of, which ones I'm going to keep, which ones I'm looking at to maybe add to my portfolio down the road, and hopefully you'll be able to comment below some of your thoughts and opinions about what I'm doing. And at the end of the video, I'll share with you how much money I made in dividends in the month of March. Welcome to the channel. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. And in this video, I'm going to share with you my Webull portfolio. This is where I keep all of my individual dividend-paying stocks. And right now, Webull has a promotion that if you open a Webull account and you fund it with some money, you can get 5 free stocks. When you open the account, you get 2 free stocks up to $300 value. And if you fund the account with some money, you get another 3 stocks up to a $3,000 value. So go ahead and click the link in the description below and open up a Webull account so that you can get your 5 free stocks. And hopefully those stocks will be dividend-paying stocks so that you can start to earn a passive income in dividend investing. So one of the first things I want to share with you today is this particular screen here. And this screen shows the diversification that I have in my Webull portfolio. I don't know if you know this, but there are actually 11 sectors in the market. And it's a good idea to be properly diversified, or at least have some holdings in each of the sectors. That way, if one sector really takes off, you're going to be able to capture it. If one sector is not doing very well, you're not going to have all your holdings in that one sector, and you're going to be able to be diversified a little bit so that you can balance out your portfolio by being diversified across multiple sectors. There's 11 sectors. One of them is energy. The next one is consumer staples. The next one is utilities, materials, industrials, healthcare, communication services, real estate, consumer discretionary, financials, and information technology. And there's kind of this last one here, it's called miscellaneous, and that's actually for ETFs usually. Usually ETFs fall into what are called mixed funds because ETFs will usually invest across a broad range of the market, which will include several different sectors. So if you want to have just an individual sector, you've got to pick that stock out of that sector. So today what I'm going to do is I'm going to go through and I'm going to look at my communications sector. I'm going to go by alphabetical order here, and I'm going to look at my communication stocks and the positions that I hold in the communications sector, and I'm going to kind of go through an evaluation of why I'm selling some of them, why I'm going to keep some of them, and which ones are on my watch list. So let's go over here to my spreadsheet. And this is my spreadsheet that keeps track of all the different positions that I hold and have. And so these are all my communication services or my communication sector. And I have 2 shares of Para, which used to be Viacom. And so right now, if you look at Para's got a 34 dividend grade. It's not very great. The payout ratio is really good, but the rest of the scores here are not that good. However, over here on Seeking Alpha, they actually rate it as a buy in several places or a hold on the quant ratings. And the dividend safety is a C, which means that I'm probably going to keep it for now and hold on to it. It does have a 5-year growth rate of 6.83%, so that looks really good. The dividend yield is 2.5%, which is also a decent dividend yield. And so I'm going to keep this stock for now and add to this position because I think this is going to be one of those ones that will end up being a good position to keep. All right, the next one is Orange. Orange has a 17 dividend grade, which is not very good. As you can see, it's pretty much the only thing that does anything here good for Orange is the payout ratio, which is 5.61. And when I first started my dividend journey, one of the things that I looked at was dividend growth rate or dividend yield, which is 7.74% over here. And the dividend growth rate is 5.61, which is pretty good. And so dividend yield was all I looked at. I didn't look at the rest of these factors here. I didn't look at the whole overall grade that was happening. And so when I bought Orange, it was because I wanted to have 7% return. Well, if you look over here under Orange, under Seeking Alpha, it shows the company's ability to continue paying the current dividend amount is an F. So I don't know that I want to have a holding where I might have a great dividend right now, but maybe in 2 or 3 months, it's it's totally dropped down to nothing, or maybe they have to put it on hold because they can't support it anymore. So when you buy dividend stocks, you definitely want to have a nice yield, but you also want to be able to buy into positions and holdings of companies that are going to be around for a while and have a decent growth rate. Even though Orange has a nice growth rate of almost 7%, and it's definitely got a dividend yield that worth looking at. I don't know if I'm going to keep it with an F and a D and too many holds here, so I'm probably going to sell out of my position in Orange. The next one here is Shaw Communications, or SJR. SJR has a 21 dividend grade. Still not very good. A lot of red here, and which is not good, but it does have an earnings per share growth trend in the right direction, 100 out of 100. That's good. Shaw Communications over here does have a C- on the dividend safety, which is better than an F, which was the last one we looked at. Dividend yield is 3.05. 5-year growth rate is 0.9, so not that great. I'm probably going to sell my position in SJR and use that money to buy into other positions. All right, next one I have here is TELUS, TU, ticker symbol TU. So TELUS has a dividend grade of 46, so it's getting higher. We're going the right direction here. Free cash flow looks good. Net debt to capital ratio is kind of in the orange there. Dividend yield 4.85, and one of the reasons why they say even though that looks like a fantastic yield, but it's a 40 out of 100, is because it's not sustainable. That's what this grade is showing, that even though it's a fantastic yield, it's not sustainable. And when you're grading dividend stocks, you want to have that sustainability, that ability to have that dividend continue year after year and then even have it grow. According to the TELUS here, it's absolutely, interestingly enough, dividend safety is a C-, so that's actually better than an F. It's a buy for quant and Wall Street over here. And so I'm probably going to keep TELUS, honestly. It looks decent enough. It's got a 46 dividend grade over here. It's got a buy rating for the quant ratings for Seeking Alpha. I'm probably going to keep my position there. It's got a yield just under 4%, dividend growth rate 1 year. The 5-year growth rate is not that fantastic. It's actually a negative number, but I already own it, so I might as well keep it and then see if I add to it. All right, the next one here is Verizon, and Verizon is one of those ones that we all know about and love, potentially. Verizon right now has a 63 dividend grade out of 100, so it's got a great dividend payout ratio. Free cash flow is fantastic. Some of these other ratings are struggling. Again, the dividend yield is 6.07. And that's, again, 20 out of 100 because it doesn't look like it's necessarily sustainable. Let's take a look at what Seeking Alpha has to say about Verizon. Seeking Alpha rates it as a C for dividend safety. Dividend growth is an A-, dividend yield is an A-, dividend consistency is an A. So Verizon is definitely one of those ones where you should have that in your yield, especially with a 5% yield. That's a fantastic yield. It does have a 2% 5-year growth rate, which is really good, and then 17 years of dividend growth. So Verizon is definitely one I'm keeping in my portfolio. I'm going to be adding to this position and getting more shares so that I can take advantage of this dividend yield, which is fantastic. All right, the next one here is Vodafone, or VOD, and VOD has a 23 on the dividend grade, so not that great. It's in the reddish, orangish, kind of a dark red. Net capital ratios, you can see all these ratings here are in the red except for the one, which is the free cash flow. Let's see what Seeking Alpha says. Seeking Alpha says the dividend safety is a D, dividend growth is an F, the yield is an A+, which means it's got a great dividend yield, but it's not doing very well on its safety or growth, or even on its consistency. So we have a 6% dividend yield, but it's only got less than 1% 5-year growth rate, and dividend growth is over 2 years. So I'm going back and forth a little bit on Vodafone, actually. There's part of me that wants to keep it, and there's part of me that wants to sell it. So I may keep it for a minute and see if it kind of corrects or gets a little better here on some of these scores in the next couple months. For now, it's on my list of chopping block. So what do you think about the positions that I've shared with you so far? Are these positions that you have in your portfolio? Are these ones you're looking at in your watch list? Or are these ones that aren't even on your radar because they're just not anywhere close? Put a comment below, let me know. The next one here is at&t, which is ticker symbol T. Right now, T is got a lot of love it or hate it kind of a position. It's got a 60 on the dividend grade, which is good. It's actually in the light green, and it's got a lot of good positions here, good things about it. Earnings per share growth 100%, current ratio. Some of these other things are a little bit struggling, but some things are really good. So it's got a 60 out of 100, which is good. at&t over here has a on the dividend here as a dividend safety of a D. They just cut their dividend, frankly, because of the spinoff. So that's probably part of the reason why there's a dividend safety issue. But dividend growth is a C, yield is an A+, and consistency is an A-. So again, when you're really looking at a holding, you want that dividend consistency. It's got a 4.7% yield. The annual payout is $1.11. It's got a 5-year growth rate of 1.5, and we just had a dividend cut, so there's no dividend growth. And the next one here is MBT. I don't really know how to pronounce that, but it's Mobilne Telesima, whatever. It's a Russian company. And unfortunately right now, because it's a Russian company, it's got a halt on the trading. So it's a 21 dividend grade. I think they just actually declared that they suspended their dividend for now because of the war in Ukraine and Russia and Ukraine. And this is a Russian company, and I think that at NASDAQ or whatever it's traded on has decided to put it on a hold. So you can't even buy or sell your your MBT right now. So unfortunately, I can't buy or sell it. But if I did want to, it looks like a lot of strong buys here. There's, again, as I shared with you, MBT does not currently pay a dividend, but they were paying a dividend, and it was pretty substantial. If you see over here on my account, I've got this 21.76%. So that was the dividend that they were paying up until the war in Ukraine broke out. They were paying a 21% dividend. Again, when I was out there looking for dividends and I was just going after the yield and I wanted to get the biggest yield, MBT looks fantastic. Of course, 21%. Who would not want 21% dividend yield on their stocks? That's absolutely fantastic. And honestly, it is, according to Seeking Alpha, the authors in Wall Street's a strong buy. The Quant Ratings, which is Seeking Alpha's proprietary system, has it as a hold, which I'll hold it then. I'll hold it and see. I can't buy or sell it anyways because it's halted because of the war. All right, let's take a look at the next one here. Telefonica, which is a TEF, ticker symbol. So let's take a look here. This one has a 20 dividend grade, which is not good. It's in the red and doesn't look good on TEF. Let's see what Seeking Alpha has to say. Again, dividend safety is an F. Dividend growth is a D-. Dividend yield is an A+, which of course 6.9%. Who wouldn't want almost 7% dividend yield? But then it's got a 5-year growth rate of -13 almost percent, and growth rate is 0 years. So I'm of the opinion that according to dividend safety and some of these other things, I'm probably going to sell my position in TEF and get rid of that. So I did a screener on Seeking Alpha to see what I should have on my watch list, or maybe replace some of the stocks that I have with these other positions. And what I did is I came up with, I wanted to have a good yield, so I was looking at 3% or higher, and then I wanted to have a strong growth rate. I wanted to have at least a positive growth rate, so I looked at a growth rate of 2% or more over the last for the dividend 5-year dividend growth rate. And I also wanted to have companies that were at least in holding position or buy or strong buy. In the communications sector, there was 5 stocks that came up, and these Verizon I already had, and these other ones now I put on my watch list. So let's jump in and take a look at each one of these and see how they look. So SBGI was on the list here. Dividend safety is a C-, dividend growth is D+, dividend yield is a B, dividend consistency is a C. Not that great, so I'll keep it on my watch list for now. Now CCOI, this one looks really good. Dividend safety is a B, dividend growth C+, dividend yield B+, dividend consistency B-. It's got a 5% yield, 15% 5-year growth rate, and 9 years of dividend growth. That's definitely one I'm going to have on the top of my watch list. Have you guys got CCOI in your portfolio, or is it on your watch list? Let me know in the comments below if you have it on your watch list or if it's something that you're looking at. Next one here is IPG, B, B+, B-, B, fantastic. 3.5% yield almost, 3.25, 11, almost 12% 5-year growth rate. This company looks really good, and it's got a great price. And it looks like it's down right now, so it's on sale. Fantastic. This is definitely going to be one of the ones at the top of my watch list. And then OMC was on the watch list here that came up on that screener. 3%, over 3% dividend yield, 5% almost 5-year growth rate, dividend growth 6 years, dividend safety is A-. This is a great company, so OMC is definitely going to be at the top of my list. I think the 3 that I'm going to have at the top of my list are CCOI, IPG, and OMC. Those are the top 3 that I'm going to have on my watch list. So now let me share with you how much money I earned in the month of March in my overall portfolio. So I earned $90.85. So what that does for my chart here is it shows you that this green chart is what I'm earning for 2022, And as you can see, my first quarter of 2022, by comparison, is killing all the other first quarters for the last several years as I've had my portfolio. I started my investing portfolio in dividend stocks in 2019, and so I've had it for now 3 years. So I'm pretty excited to see how this year goes and what this looks like as we move into the rest of this year. So I have way too many holdings. I have way too many in each sector. I'm going to narrow it down to the top 3 to 5 in each sector, and hopefully you'll see what I'm going to be doing in the next little while in the communication sector based on this video. I hope you got a lot out of this video. If you missed the last video I did, you can find it here. Go ahead and subscribe to the channel up here and check out this video up here if YouTube thinks you might like. I hope you have a great day, and I look forward to seeing you on the next one.